We have a great question here from Kerrick asking about the Aussie dollar, saying that he can see from our fundamental strength meter that we have a bullish bias on the Aussie dollar right now on a fundamental basis, and wants to know why we are seeing the Aussie dollar so bullish when the market doesn't expect the RBA to raise interest rates for the next couple of years. So I think this is a fantastic question, Kerrick, especially in the current environment that we're finding ourselves after the pandemic, because it's also a good example for not only times like this, but normal market conditions as well. Now, you are right that the markets are not really expecting any interest rate hikes from the RBA for the next couple of years, but context of what is happening globally with other major central banks is always just as important in terms of our considerations for a particular bias for a currency. So if we take a look at the interest rate probability tracker inside the terminal, we can see that interest rates are either just below or just above 0% for all the major central banks. And the reason for that was, of course, the synchronized easing cutting of interest rates that was put in place by central banks around the world by cutting rates down, introducing quantitative easing, introducing other measures as well as we went through the COVID crash, of course. So if you look at the RBA in isolation, the fact that they are close to zero, and the fact that the markets aren't expecting any interest rate hikes for a very long time, that by itself might seem negative for the Aussie dollar. But when all the other major central banks is also close to the zero bound and also not expected to really raise interest rates for a very, very long time, then that isn't really that much of a big deal in terms of importance, and means that in these types of environments, interest rates might not matter as much as they usually would. Remember that in fundamental analysis, it's never just one thing like monetary policy, right? It's always a combination of factors that we need to consider in order to establish whether one currency should be stronger or weaker than another, or whether one currency should appreciate or depreciate against another. And of course, in usual market environments, monetary policy is normally going to be your biggest deciding factor to consider for currencies in terms of interest rate expectations. But in a context like we are dealing with right now, it's not what matters or might matter the most for that particular currency's bias. So just a quick example of the Aussie dollar then, while we're on monetary policy, let's start with monetary policy in this example, right? Arguably right now, the RBA isn't anywhere near hawkish, just like any of the other major central banks. But after their last meeting, they put in quite a few additional easing measures. They cut down rates down to 0.1%. They lowered their yield curve target. They also adopted a more traditional QE program as well. And after all of that was done, seeing that Australia's economy hasn't really been hit that hard compared to some of the other major economies, it means that it's going to take something really, really devastating to cause the bank to do even more easing than they've already done right now. And that means that right now, the market deems the current monetary policy as appropriate for the RBA, as long as the economy starts to show signs of recovery as expected in 2021. Now that'll probably, have been, so with that in mind, the most recent easing is probably going to be the last easing for this particular cutting cycle. Now that can, of course, change, but that's where we are right now. So that's one less, let's call it a bearish headwind for the currency to worry about. Now, let's look at another one. In terms of economic performance, yes, the economy has done much better compared to the rest or some of the developed economies, but we know that economic data hasn't really been that important for the markets over the last couple of months, not after the crazy numbers we've seen in things like GDP across the globe. But nonetheless, the Australian economy did do very well to curb the virus compared to the rest of the world, and the economy has taken a much less severe knock than originally thought. So that's arguably more bullish for the Aussie dollar. Then we can also look at something like fiscal policy. Now, the government in Australia, as well as the RBA, have done quite a lot to support jobs in the economy. And according to some analysts, the implementation of the job protection policies and programs have been one of the key driving factors of the recovery that we've seen in areas like the labor market in Australia. But arguably, when it comes to fiscal policy, it's not something that something that makes the Aussie dollar alone more bullish compared to other currencies. because most of the major economies has done quite a lot in terms of fiscal policy as well. So that's a little bit more of a neutral aspect for the Aussie compared to some of the others. Then we can move on to intermarket analysis. Now, that's really where a lot's going on for the Aussie dollar right now. And arguably, in my opinion, something that's been a little bit more important than monetary policy or interest rates. Firstly, considering the Aussie dollar is a pro-cyclical currency. Now, that means that it tends to do really well whenever the global economy goes through early recovery stages or expected to go through early recovery stages like the markets are expecting right now to occur in 2021. So that is a positive bullish factor for the Aussie. Apart from that, there's expectations for a broad-based further depreciation in the US dollar and for the dollar to move into a possible more secular downtrend in 2021. And that's been very positive for things like commodities. And that's also been one of the key drivers of inflation expectations over the short term. And that has really seen lots of support for commodities across the board. And all of that is very positive for the Aussie dollar, which is a commodity sensitive or a commodity dependent currency. Another consideration for this is, of course, China. Now, China is the biggest trading partner for Australia. About 35% of Australia's exports goes to China alone. And of that 35%, 44% of that is iron ore. And recently, we've seen iron ore on just an absolute rip to the upside. And the main reason for that big drive has been a massive surge in demand from China. Iron ore is up, I think, almost 40% year to date, as that overall recovery in China's economy has seen lots and lots of demand coming in. And what's good for China is usually good for Australia. And another thing to consider is the US dollar Chinese yuan. So we've seen that US dollar Chinese yuan just continue to move lower, seeing lots and lots of strength for the Chinese currency. And that is, of course, good once again for Australia, because it makes buying Australian goods all the more appealing if you're buying it with Chinese yuan. So that's another big driver or positive driver for the Aussie dollar. Now, there is, of course, risks to that bias. As there always are, especially on the geopolitical side. There has been tensions between China and Australia, but until China starts, tackling these products that really matter, it's not going to have that much of a big deal or big impact for the Australian economy overall. So, this was just a quick rundown of a basic fundamental analysis process that you can go through. And the aim with this video was to firstly, of course, answer your question about why we are bullish on the Aussie dollar, despite the fact that the markets are expecting rates to stay where they are for a very long time. And secondly, the aim of this was to give you an example of this type of process that you can go through on your own to do the similar type of analysis for other currencies as well. Knowing that even though monetary policy and interest rates are always a very important consideration and important factor, they don't always matter the same depending on the particular context that we're in. For the global economy. So I hope that helps, Kerrick. Any other questions, please don't hesitate to let us know.